Japanese index, as we speak, is down almost 250 points.
The August inflation number making a huge disappointment for markets, looking for a peak inflation and for a Fed to do fewer rate hikes. All of that going the wrong way.
It will envisage standardization of physical assets, benchmarking of service levels, and harmonization of documents.
This reward could favor a bullish trade.
They have downgraded TCS, Infosys, and Tech Mahindra to sell from buy.
The street will be waiting by to know what they want to do with this money. They're already sitting on cash of close around $1.5 billion odd.
The Nifty is now down 280 points. The Sensex is down 960 points.
This country's economy is in reasonably good shape.
More than 60% is our industrial bearing and 40% is the automotive bearings.
Definitely it's below expectation, but still it is in double digit and, consecutively in double digit since last year's April. So I don't think that should give us any big relief.
This will be changing our India. Today import is $35 billion, going to be $300 billion in 7 to 8 years' time.
Nifty is up 270 points from the lows. Bank Nifty in the green with gains of 530 points.
Well, that was a day so far. Hello and welcome to a fresh new edition of Closing Bell. I am Prashant. With me, my colleague Nigel. Nigel, hi. I mean, I think one can write down today's session, and because it's going to go down as one of those sessions which you will look back and remember. Just amazing. I mean, resilience is one thing, but I can run out of adjectives describing what we are seeing on the screen. I don't think I've seen a market like this. I reckon a lot of people who've been in the market a long time. I mean, I've seen this market since 2004, reported on it since 2004. I don't think I've seen something like this play out. I mean, you got a 5% down day in the US market, right? Arguably, which many describe as I don't particularly like that phrase, but the mother market. And, you've got positive, you've got green on the screen, 10 points, whatever. The fact is just amazing. I mean, US futures are up 0.5% or so, but they fell 5%. European equities are flat. It's not as if there is any great carnage there. Asia was more down. I mean, actually, progressively, it's getting a little better. After that sharp 5% fall, Asia, the worst hit. European markets not doing that badly, and US futures are actually indicating a small bounce at this point in time. Banks are basically what is leading to this bulk of this gain. I mean, I actually just counted quickly. On the Nifty, the banks themselves are contributing almost 100 points on the upside. I mean, bulk of the pressure, of course, is coming in from IT. The index itself, the IT index is still down 3%. And you've got this kind of strength as far as the benchmark Nifty is concerned. FI flows have been extremely positive, and there is no way to know it because, I mean, very, very tough to say who's buying it on any given day. But I think the theme is generally what one understands is this seems to be very specific India-related allocation, very deliberate allocation to India, which is being made. And that's why you're seeing these very chunky, large 1,500, 2,000, 2,100 crore kind of numbers over the last many trading sessions. And I think that's the bedrock on which the market is doing what it is doing. 18,077 is almost as if nothing happened. We're pretty much flat day on day. Nigel.
Well, Prashant, what a fabulous market this is, right? The bulls will be very, very happy. And the bulls really, they passed the test. That buy on dips thesis, well, that's pretty much intact because you bought the dip today and you'll be pretty happy. We're at the high point of the day with around 15 minutes to go to the end of this trading session. The day's low was at around 17,770 approximately. And from them, we saw a bit of a bounce. The Nifty Bank, that's the driving force. Just take a look at the intraday chart out there. It's a 1,000-point recovery from the low point of the day. Pull up the Nifty Bank, the intraday chart, though the IT index has taken a bit of a break and pull back because of the global concerns. Writing is still being seen at around the 17,800 put, the 17,900 put odd. So the short point is the support zone is clear. 17,650 to around 17,700. The 20 DMA as well is in that vicinity. And we here at CNBC TV 18 indicated this morning, if the SGX Nifty was suggesting a 350 point downtake, if you get that, risk reward could favor, buying the dip. And that's precisely the way it's played out as of today. So good to get it right occasionally. And in fact, you are seeing a good recovery. But we've got still 60 minutes to go. Anything can happen. For the time being, though, the bulls will be feeling very, very good the way the Indian markets have outperformed in comparison to the mother market, the US market, or even its Asian peers. First up, though, let's run you through what all we have lined up on the show for you. Vedanta rallying in trade post the announcement of its first semiconductor unit in Gujarat. Excerpts from the chat that we had with the chairman, Mr. Anil Agarwal. That's coming up in just a bit. Banks, the talk of town today, holding up steady in an otherwise weak market. Stocks of SBI as well as IndusInd Bank, they are clocking in gains on the back of robust management commentary. And the laggards in trade today, that's IT Pack. In our special segment, Standard Brokerage Report, we'll get you the rationale behind Goldman Sachs' bearish view on the sector. And finally, our Alpha Manager of the Day, Aditya Sood of InCred PMS, will be joining in to discuss his top sector and portfolio bets.
All right, so that's what's lined up here over the next 60 minutes or so. Well, what should you do now is the question, right? Mitesh is with us. Mitesh, I mean, I'm blown away. I don't know about you, but what would you advise?
Prashant, one, I think, I mean, if you would have asked me 1,000 times, I would have said 1,000 times that the market can't be positive today at the end of the day. I think I was dead sure that, we'll get a bounce back or something which we're looking at definitely. We did suggest that, 17,870, 17,850 zones might hold and you might see a bounce back. But I thought 18,050 could be it and we might actually just, kind of taper around and then get into consolidation. But this is a very strong and a much more, powerful recovery than we thought. Obviously led by banks. Very clearly, I think the bank Nifty, which was on the all-time highs, I think has maintained that status, and this should now at least propel Bank Nifty to the near-term target of 41,850, which is what we've suggested, and eventually to medium-term targets of 43,500 to about 44,000. So I think that should keep the Nifty in good health, and therefore I think maintain a positive stand even now. The stocks that I have on recommendation list are Can Bank. That's something breaking out with good price and volume setup. So it's a buy with a stop below levels of 247. Look for targets of 267 here. And Britannia is something, which we had on buy list yesterday as well. It kind of opened down, but is recovering now. It's very close to the yesterday's close. So I think this could possibly see some continuation on the upside. That's a buy as well. Keep the stop below today's low of 37.08 and look for targets of 38.50.
Okay, all right. Thanks for that, Mitesh. Splendid recovery. It's caught everyone by surprise. And, you pull up the advanced decline ratio. We only look at the headline index and saying there's a big recovery from the lows. The advanced decline ratio as well, the number of stocks that are advancing are getting closer to that declining. And just take a look at it. It started off with not even 500 stocks were in the green. Now you have closer to 1,300 stocks that are in the green. So that's telling you the breadth of the market as well has improved. Gurmeet Chadda, managing partner at and CEO of Complete Circle, joins in. Gurmeet, what a day, right? India's striding ahead. Valuation-wise, we're not cheap. But just looking at the screen, looking at the Asian markets that were under pressure, Nifty is in the green now. Nifty Bank is flying away. Overnight, if you were tracking the SGX Nifty and the Dow and all, you would be really disappointed. What are you making of this market?
Nigel, tremendous resilience. I think I don't recollect seeing Nasdaq down 5% and Indian markets putting up a decent show. Probably, we sometimes, maybe there is some news which probably is macro news, which is around the corner. I don't know whether it is inclusion in the global bond index, inclusion, increase in weightage in something. There's probably something which could be the case, which probably is going to price. Also, I think the index could also be a little misleading in terms of while obviously it's a smart recovery. I think the market is probably differentiating in terms of things which will do well and things which probably be under pressure. Like IT index is still 3-4% down, for the leading names being down, and Bank Nifty's made a new high. So I think the market is differentiating where earnings support would be and where probably margin pressure would and inflation pressures would continue. And mind you, they have pulled out $50 billion and pumped back $6-7 billion only. So also I think the positioning is also much lighter. So some of it could be related to that. But I think maybe some macro event is probably around the corner, which probably would reflect once these sometimes price action precedes that.
Maybe I'll throw a line your way with what someone told me half an hour back. Paji, kuch to izzat rakh lete US market ki. Just amazing, right? But you're right. I mean, that bond index inclusion is perhaps, I mean, we could hear something this month. So yeah, you're right. The other thing about the weight itself for stock indices, that, I mean, the weight itself, of course, changes as markets become bigger and grow, so the weight automatically increases. But this does seem to be, as I was saying, dedicated inflow, very deliberate inflow for India because of what other emerging markets are doing or not doing. They're doing very badly. I put that piece out in detail 2 weeks back. That seems to be a very logical explanation. Otherwise, with this kind of global environment, very chunky flows coming in, it will baffle you. So, Gurmeet, what are you doing? I mean, you're raising money, you're deploying money, you're getting new money. I mean, it's not an easy place to be a fund manager. To comment is easy, but to put money to work as markets continue to gallop higher is not easy.
No, it's tough, Prashant. So we're maintaining about 10-15% cash. We are not out of the market. I think that's a prudent thing we did. And as I said, there are opportunities. You probably have to be a little contrarian at the same time. Do not get carried away. So, if 10-year US continues to inch and cross 3.5 and maybe get closer to 374, there will be some repercussions because the discounting rate goes up. And the first thing you need to do is don't overpay. I think in a market like this, the worst mistake you can do is, pay. So even in IT, for example, we were discussing, while the index is down, you are still at 25-30% premium as far as pre-COVID is concerned. So within IT also, you have to be careful in terms of, I think better clarity will come once the earnings come. But maybe if you're getting good names at 14, 15, 16 times earnings, maybe you can gradually start nibbling into them. It happened with auto, if you recollect, a few months back, when there was all negative news in terms of disruption, supply chain, semiconductor chips, and stocks slightly moving up. So this market probably got to be a little contrarian, pay more reasonable valuations for the multiple, and maybe keep some powder dry. Opportunities will just keep coming, as I keep saying. And once the earnings season start, I think differentiation will happen, and from there on, probably it can become a more stock-specific market.
Okay, all right, Gurmeet, stay with us. Let's talk about the sector of the day, the banking stocks. IndusInd Bank, SBI, they're surging in trade on the back of a Morgan Stanley note. It's also important to note that SBI is the third bank to cross the 5 lakh crore market cap. Abhishek's with us to run us through all of those details. Abhishek.
Well, Morgan Stanley had its conference wherein, they had SBI as well as IndusInd Bank management coming over there. So to start with SBI, they have an overweight rating with a target price of 675 per share. The key takeaway is that the loan growth momentum is expected to remain strong, and SBI expects margins to improve from here on onwards, given the fact that Q2 FY23 margins will start showing improvement. So asset quality remains benign and digital initiatives are gaining strong traction. So in terms of operating efficiency or cost to income ratio, they expect that to moderate over the next 2 years. Morgan Stanley is also written on IndusInd Bank, wherein they have an overweight rating and a target price of 1,400 per share. The key takeaway from management, in their conference is that growth visibility continues to improve. The deposit traction is coming back. So IndusInd is targeting deposit growth of 18 to 20%, led by strong traction that they are seeing in their new initiative. Margins should remain stable despite a rising interest rate scenario. Slippages or formation of bad loans, that should moderate, and that would help in keeping the credit cost under control. That is around 120 to 150 basis points. Back to you.
Okay, that's, banks basically which are roaring, absolutely roaring at this point in time. Gurmeet, I mean, that is a space, right? Now, take the case of IndusInd Bank. It's a large bank. Of course, I mean, not top tier, maybe second tier. Still far away from its pre-COVID levels. Valuation-wise, it's kind of cheap. I mean, it's just rotation, right? Which seems to be at work. Your thoughts?
So, Prashant, I think what has happened in banks is, as you said, there is a rotation happened. There was a time when HDFC, Kotak, IndusInd also at its prime used to get 4 or 5 multiples. And there was City Union Bank, for example, right? Used to command higher multiples, and there were banks which were struggling to even get book value. Probably there's some mean reversion happening, as you can call it rotation. Even HDFC Bank, for example, if you see the PAT in 2019 was 19,000 crores. and last year they did 37,000 crores. And the price virtually is for 10-12% up in 3 years, right? So, but and I've not seen HDFC Bank below 3 book multiple for a long time. But that 4 or 5 multiple came for premium credit quality, 20% plus credit growth, which now a lot of banks are matching up. So example, SBI, Abhishek made that point, making a new high. If you see the operating metrics, see the credit cost last quarter, 61 basis points. See their slippages. They continue to moderate. I have not seen net NP of SBI 1% for a long time. In fact, I was seeing their restructured pool, their SMA1, SMA2 looks pretty good. Their advances at that size of the book, is 16% growth. I think what you will see now in banks is a huge liability war and a rush to raise deposit because credit growth is 15-16%. So bank with automatically high CASA, 45-50% CASA, which is ICICI, HDFC, SBI, even Axis to an extent, will start, gaining more, both in terms of names, both in terms of HDFC, for example, would need huge deposits just because once the merger goes in. So we still like ICICI, SBI, HDFC, continue to be our portfolio stocks. Also, we like some of the banks at the lower end where we are seeing, the books becoming gradual, like IDFC First now, the infra book is just 5% now. Retail loans are almost 70%. Deposits also, they are doing well. CASA, they are doing pretty well. So some of the banks there, we are beginning to, starting to, nibble into.
Okay, all right, good. Let's focus on the sector that's getting clonked, the IT sector. That's in focus on the back of the negative commentary coming in from Goldman Sachs in its recent report. Nimesh alerted us about that. He's joining in to fill us in with more details. Nimesh?
Hi, Nigel. So there are two reasons why the entire IT basket is under pressure today. One, of course, last night Nasdaq was sharply down 5%, and there are now global concerns. And two, today Goldman Sachs put out a note, and they've downgraded the top-notch Indian IT names. Now, they believe the valuations of Indian IT companies are still very expensive, and there is a clear signs of down cycle going ahead. In fact, so they've downgraded TCS, Infosys, and Tech Mahindra to sell, and they've marginally upgraded Wipro to buy. Now, they believe the dollar revenue growth for the top Indian IT companies are going to materially slow down from here on. So so far FY24, so calendar FY24, Goldman has cut the revenue growth estimates by 4 percentage points to 6% now versus their earlier expectations of 10%. And the price to PE multiples are still very high for most of the Indian companies, and they are not factoring in the growth slowdown. In terms of individual recommendations, Goldman has cut the target price on Infosys to 12.22 now versus the earlier target price of 17.22, and they've cut the FY23, FY26 EPS expectations by 6%. On TCS, they've downgraded the stock to a sell with a new target price of 2,611, which is way lower than the earlier target price of 3,678. Even for TCS, Goldman has cut the FY23, FY26 EPS estimates by 5%. On Tech Mahindra, they've downgraded the stock to sell now from neutral, and there they've cut the target price to 868. The only upgrade is on Wipro, but again on Wipro, the upgrade is largely on attractive valuations. Even for Wipro, the Goldman has cut the EPS estimates by 1 to 3%. So, the big worry is that the dollar revenue growth is going to slow down from here, and multiples have still not corrected, and the valuations are expensive, and hence a big downgrade on TCS, Infosys, and Tech Mahindra by Goldman Sachs today.
Okay, all right. Thanks a lot for that, Nimesh. By the way, we had some news that was flashing for you on the screen. Sources to CNBC TV18, the ED is conducting search operations in a lot of cities across the country. That's Mumbai, Delhi, Gurgaon, Kolkata, as well as Lucknow of Chinese companies facilitator. Searches include some gateway companies as well, payment gateway companies for specific transactions, and that's why Paytm is a stock that's suddenly seen a bit of a downtick in the last few minutes because the search covers certain premises of Paytm as well as PayU. So Paytm, the stock did see a bit of a downtick. Now, in fact, it's holding with a cut of closer around 1.5%. Gurmeet, any view on Paytm? First of all, when it came out with its issue, people were waiting for it. People who got it in the issue, I mean, hard luck for them because the stock is a third of what it was at. What's your take on the stock?
So Nigel, staying away for now. As I said, this market may not be very, favorable to companies which still are not clear on the glide path to profitability. I think if we see more traction in the payment business, I think lending also, they are very aggressive and a lot of it is co-origination. the easiest thing in India is to do credit growth aggressively. And then we have seen those cycles in a lot of NBFCs also. So I think we should see how this next growth lever, which they're focusing on, which is lending and third party, plays out. There are better plays in financial, Nigel, if you want to play the fintech. I think CDSL to me is a better fintech play. We continue to add cross 10 crore demat accounts, seems to be a very structural play. Now we have insurance depositories coming in. So it's to me that's a better fintech play. When do you get 100 crores revenue at 60-70% EBITDA margins, right? That's great business to be in. Similar with CAMS, which again is a duopoly structure. As mutual portfolios go up, again a duopoly with Carby and CAMS, CAMS having almost again 68% share. Some of the unlisted names may come in. We did take part in NSE unlisted some time back. And I think now insurance also seems to be slightly coming back, with the worst two period behind it.
Okay, what we'll do is we'll take a quick break here, and we'll come back with Gurmeet and more. Market, by the way, is down 8 points. I mean, flat, absolutely flat. We'll have Aditya Sood of InCred PMS also join us on the other side for more market conversation. Stay with us.
Welcome back. Well, the markets are holding more or less flattish. A flat day is something that the bulls would have been hoping for all night, and they precisely got that as well. The mid-cap index, by the way, is on the verge of moving to the green, so that's telling you the kind of strength that we're seeing in the markets, while the Nifty Bank is in its world of its own, up closer around 700 points. Gurmeet, before we went into the break, we had that news coming in, and you gave us your view on Paytm. Stay away is what you thought out there. What about IT? Goldman Sachs note, well, they are highlighting various challenges. What do you think? I mean, some of those stocks, valuation-wise, they're looking pretty good. What would you bet on?
So, Nigel, I think the better approach is that to probably do it in 2 or 3 parts, maybe something now and something post the earnings set in, because that's when you get better clarity on is the decision making still stopped? Are the contracts getting repriced? What's the cut in spending? Basis our discussion with a lot of CTOs, etc., in terms of clients we speak to, the large enterprises aren't cutting as much. The smaller ones, there are some discussions happening. Also, I think the graduate uptake, because that was the solution for a lot of the supply side and attrition problem. The graduate utilization uptake hasn't been satisfactory, both in terms of they being billable as well as the client satisfaction metrics. But I personally think that only when there is a problem, you will get a lot of the names 30-40% cheaper. When things are good, you get them at very high multiples. So we've seen that so many times with I think Indian IT services, overall, I think if you take a long-term view, I think there is no issue. There will be, 1 quarter, 2 quarter softness. I think, so if you see, for example, in large names, we continue to, accumulate Infosys, barring the banking vertical and maybe some softness in retail, the manufacturing and other verticals seems to be doing well. Digital is now 62-63% of the revenue. And they're taking a call of higher, revenues at some cost of margin. So probably 21-22% looks optimistic. But if they can meet double digit, I think we should be okay. And some of the ERD names, which is engineering, research, and design. That's where I think the nature of the contracts, the core outsourcing is much more long term, and that's what we are tracking right now in IT.
Okay, all right. Thank you very much, Gurmeet. Appreciate you joining in, and it's always a pleasure having you with us here. Thanks indeed. Well, let's welcome in Aditya Sood, portfolio manager at InCred PMS, who's also joining in to take some questions. Aditya, great to have you with us here. Thank you very much for your time. So what have you been doing, Aditya, at your fund? How are you dealing all of this up and down? It's mostly up, very little down. But yeah, your views.
Yeah, so thanks for having me on the show. I think so last time we spoke, it was more about, bottom-up stock picking. So the environment continues to be very, very constructive. What we are witnessing at this point in time is that, Micro is obviously much better than macro. Obviously, there are some concerns about the bond yield differentials between US and India. It is at 380 odd basis points, the lowest in last 12 years. Clearly, we are in an environment of readjustment. So that theme continues to be there. I think so. A lot of businesses are trying to find their foot in the door, because this is the first time wherein we are seeing such a high inflation environment. So our focus has been on categories wherein demand is holding up. And obviously, this is a very good time to stock pick because India obviously is the brightest spot within the emerging market. As we see, inflation differentials between India and the West continue to be at a reasonable level. I think so. We'll continue to be in a market wherein earnings growth, hopefully from Q4, should start to look up as the commodity price inflation tends to moderate, which has been the pain point for last 3 to 4 months. But in the interim, obviously, we have had many stocks which have rallied by 30-40% from the bottom. So it continues to be a reasonably constructive environment for bottom-up stock picking.
All right. Hi, Aditya. Good to speak to you. So you're hoping that earnings momentum continues and plenty of stocks out there that are finding favor. Aditya, with regard to the funds that you're managing, there are two sectors really. One is the cement space and one is the banking space. Hope of consolidation in both these two spaces, maybe in cement far more because you have a new player that's coming in there. Have you made any kind of additions in the banking or financials stocks, or maybe playing some part of the cement themes with disclosures?
Yeah, of course. We are very constructive on the CV financing space. That is where we have added a company known as Sundaram Finance. It has been a champion in CV lending. Our general framework has been to look at financial services from a perspective of AAA rated lenders who have got the previous cycle or many cycles right. Clearly, Sundaram is one of the best NBFCs to own in India. Just as extension of that theme, we see a lot of divergence within the financial space in the sense that we have small finance banks which are trading at anywhere in the range of 1 to 1.2 time price to book, and there are quite a lot of them who are trading in that valuation range. However, what we are seeing of late is that the ROAs are trending, or they have got a good chance of trending above 1.5%. They might also graduate towards being a 2% ROA bank, and this is where we are placing our bets on. So we see a lot of divergence. Obviously, we have seen the large cap banks delivering good return for investors, but we are very, very positive on the small cap finance bank space. On the cement side, consolidation obviously is a play going forward. But what we are witnessing at this point in time is that demand is something that should hold up here. Valuations are far constructive from a long-term average perspective. So we are positive on the cement space as well.
So that cement is the only thing in the building material space that you like, Aditya?
So we also like a segment known as wires and cables,
right.
Wherein we had invested into this company, which is a deep value play. It has got, which is known as Phenolics Industries. That continues to be a very constructive play for us from a slightly medium-term perspective. What we see again here is that, it is number 2 in terms of wire and cables market share, but the valuation disparity is huge if you look at, the market leader in this space known as Polycab. So we typically are finding opportunities from a bottom-up perspective wherein either earnings or cash flows are in a position to rebound. So essentially, we are playing a value strategy here wherein, multiples will get re-rated over a period of time.
All right. Aditya, what about, the auto ancillary space? That's been buzzing around OEMs as well as the ancillaries. You have made any changes out there? Sundaram Finance we've got from the, the CV theme and the financing theme out there. What about the actual play? Auto ancillaries, any changes you all have made?
So one theme that we particularly like as a house is a lot of B2B businesses wherein, we have not seen A lot of quality companies reporting a loss in last 20 years. Even during the time of global financial crisis, these companies never reported a loss. Now, what happened particularly in last 2 quarters was that, these companies reported a loss because these were B2B businesses. They had contracts in place wherein they could have easily passed on the raw material inflation. Secondly, we have also seen, some bit of semiconductor shortages, impacting a lot of auto hanks. So we have invested into a company known as Higashi Motors, wherein it is a MNC. It is owned by 75% owned by the Japs. We believe that going forward, the company should do very, very well, because if you look at the peak stock price, it was like 1,000 rupees in 2017. The stock is deep value. We believe that they have added a new segment known as brushless DC motors, which should do very, very well. So typically the theme being that, essentially, when you are pushed to the wall in a down cycle, a lot of companies try to reinvent themselves. And this is where I think so a lot of B2B businesses fit in. So we are fairly constructive on B2B businesses, be it, API or be it, selected names like Higashi.
Aditya, you like the diagnostic space as well? That's a bit of a non-consent. The consensus is that there's huge competition and there's very little value as pricing will continue to move lower for the most widely conducted tests because of competition. What's your view?
Yeah, so initial reaction, obviously, that is why you are getting these stocks, they have corrected anywhere to the 50-60%. Most of the companies have corrected. Our view here is that, the market will continue to grow. It is not very easy to establish a diagnostic business and be successful at it. If you look at, the new players that have been talked about, essentially they are outsourcing to the existing players in terms of getting the test. Second thing that we have noticed in the space is that, whatever pricing is being talked about by a lot of people is very, very selective. It is not, for the entire, it doesn't flow down to your entire, sort of the range of tests. So what we are witnessing here is that, multiples are very, very constructive. We have a B2B company which is very, very cheap. Obviously, we believe that going ahead, there is a combination of COVID business being behind us. Obviously, the focus here is non-COVID business. And what we have witnessed here, and we have witnessed some divergence in terms of trends here, that we own a company which is trying to grow the non-COVID business. And that is what we particularly like. So as
you said B2B.
Yeah, so we are focused on a B2B company here, basically, which is trying to grow the non-COVID part of it.
I mean, if you don't mind, can you tell us which one?
So it has been Thyrocare for us. We have been long-term shareholders in that company.
Right.
And then obviously there is a play on pharmacy integration as well.
Okay, all right, fair enough. I mean, that's interesting. That's as I said, a non-consensus view. I recently saw advertisement. I think it was Tata 1mg offering sort of lucky draw gold coin wins on tests or something of that sort. I mean, I was like, but that was 2 days back, and there's been a fair bit of concern around competition and what it'll do. Companies have admitted it as well, but it's interesting. I mean, your view, looking at it, market of course will continue to grow. And newer players are asking these older players, I mean, they're outsourcing the tests. The tests actually are being conducted by these older network of diagnostic chains. It's a pleasure, Aditya. Thank you very much for joining us. Appreciate you being here on the program. Thanks very much once again for being here. I mean, the market is down a little bit now, so 41 points. I mean, that would still count as being flat, nothing more. 18,029. We were up about 10-20 points, and we're down about 40 in the last couple of minutes of trade. There's still 25 minutes to go. One name, Nigel, which has been flying away has been Vedanta, right? 10%.
Absolutely. Vedanta is rallying in trade, post the announcement of its first semiconductor unit in Gujarat. Well, in an exclusive interview, Vedanta chairman Anil Agarwal told CNBC TV 18 that investments in semiconductor and allied products will be via the listed Indian entity. Vedanta will also set up a display glass that will help develop a hub for mobiles as well as laptops in Maharashtra. Let's hear him out.
Every child who is 15 years old or more, if he has a laptop, he goes to different level. Today, laptop is available at 1 lakh rupees. Once you have a chip and the glass available, I assume that the laptop can be available at 30,000-40,000 rupees or less. We are going to create a cluster. When Maharashtra is very important, Karnataka is very important. Maybe we can look at other states also to encourage from the 5 crore to 50 crore to 500 crore. Some of the higher product like EV vehicle, we might think to do with ourselves, but we at the moment let's focus purely on developing the semiconductor and the display glass. The entire responsibility to bring in the product will be of semiconductor will be Foxconn. We are supporting and helping to provide the land, building, our equity, debt, government approvals, bringing all the local support will be from our side. Entire responsibility to make.
Okay, I mean, that's a big one. Although, Nigel, I'm surprised. I mean, right? I remember the first time this was talked about, the market did not like it, that Vedanta would be making such a large investment for the semiconductor business. And now it seems to be liking it. I don't know if this is the news which is spurring the stock. So that's the question.
Prashant, there's various other rumors as well that are doing the rounds, but we'll have to wait by whether or not the promoter wants to have a bigger chunk in the listed entity. Can he honor the payments that he has with regard to the parent firm as well? But, if at the face of it, actually a rational point of view, which a couple of analysts have written, is that if they're going to put such big money, then the debt effectively, which is around net debt around 30,000 crores odd, it'll effectively double. But maybe post that, the revenue potential could be far more. Otherwise, yes, the leverage will be back on its books if they're going to be making around 1.5 lakh crore investment. Part of that will be from Foxconn for part of that investment. But still, it's a huge number. So in the next 3 or 4 years or so, you're looking at a big debt number coming into its books. For the time being, the street is ignoring that leverage aspect. They're looking at the growth and the niche market. Or maybe there could be some bit of other news or some corporate development that could be on the cards for the time being. Never rule out. Never rule out.
Very difficult to identify, well, this is why, A stock or B stocks. I mean, sometimes it's pretty clear, but I don't think in this case it's very clear, as Nigel also pointed out, what the reaction is to. It could be some covering, could be anything, any number of things, or the buzz around whether there'll be additional promoter buying from the market, etc. Well, 307 on Vedanta, it's up 10%. It was up 12 earlier, but still going very, very strong. We'll take a quick break here. We'll come back, and as always, we'll get you, a check from dealing rooms on our segment D Street Chatter. My colleague Nimesh, of course, joins in to give you that, and some BTST trading ideas with our technical expert as well. Stay with us. All right, 75 points, so a little more selling coming through, and I guess understandable. 17,994 is where we are at, which is down about 0.4% from yesterday's close, day on day. Well, time for our segment D Street Chatter. Nimesh is standing by, and he's going to tell us what the chatter in dealing rooms is with regards to today's incredible market moves that we've seen. Nimesh, over to you.
Hi Prashant, it's actually incredible. The way we've recovered from intraday lows, it's really been very sharp, and that's largely led by financials and the cement stocks. In terms of financials, yes, there is buying interest from larger FIs, and that's been the trend for the last many days. Every day that's a feedback that there is buying interest. in the banking stocks, and that's been the case today as well. So that's the reason why the Nifty Bank is up more than 1.5%. Cement is where all action seems to be. Big moves in the cement stocks. India Cement is locked at 10% upper circuit. Ambuja is almost there, 9-10% up in today's trade. I guess there is a lot of chatter now of a further consolidation as well in the cement sector, and I guess everybody is now waiting for the 16th board meet on what the Ambuja's next plan is going to be. That's what is leading to a lot of excitement in the cement sector, is what I understand from the dealing rooms. In terms of flows, while there is not big buying interest, but there is lack of selling as well. That explains the move in the large cap names as well in today's trade, and there is enough interest not only in banking stocks but some of the large cap names as well. The only sector which is under pressure today is the technology names, and we've explained since morning as well. There is a Goldman note, there are macro concerns as well, and that's where the IT stocks are under pressure, largely on selling flows. But broadly, I guess there is a lot of momentum. Technically, we are in the breakout zone, so that's helping the market as well. And there is momentum, especially in the financial names by the larger institutions.
Nimesh, what a baffling mood on cement stocks. Wow. A lot of them are up between 9 to 10% odd. I don't know what's going on there, but what's the news you're picking up on various companies?
Well, for cement, Nigel, we spoke off the record as well, right? As to there is a lot of chatter across the entire cement basket. Coming to individual stocks, the first stock on my list today is Sundaram Fasteners. There was a large block deal, 1.2% equity has changed hands, and the overall feedback is maybe one of the large FII was a seller in today's block deal, so that disclosures will be important. But looks like there is a large FII seller who sold out of Sundaram Fastener today, so that's the first one. The second stock is L&T. While the entire IT basket is down, L&T technology stocks are under pressure, but even L&T parent is under pressure today, largely on sell flows at the leading FII. So there is some bit of profit booking in L&T as well in today's trade. The third stock is Wipro. We spoke about the IT names, while Goldman has upgraded Wipro to a buy now, but I understand there's going to be market at close selling pressure at a leading FI desk in Wipro. So maybe Wipro will be under pressure in the last half an hour of trade in today's session. So that's the third one. And the last stock is Granules. After a long time, that's come into my chatter list. Within the pharma names, that one stock stood out for me today, purely on back of buy flow. So it looks like at these levels, some bit of FI interest is back in Granules, and hence that stock is slightly buzzing in trade and on good volumes.
Okay, all right. Nimesh, thanks so much for joining and giving us those quick inputs. By the way, the markets are calling for our attention. So you have your levels really sorted out now. 18,100 appears a bit of a support zone, resistance zone actually. Supply zone is what we're seeing, 18,100, 18,080. That seems to be a level where in fact we are seeing some bit of selling, and that's precisely what's happened today as well. But just pull up the Nifty Bank, which was up more than 750 points. At high levels, we did see some selling out there as well. And, it's come off a goodish bit from the day's high. Just pull up a few stocks actually from the Nifty pack itself. You have Wipro that's moved a little bit lower. HDFC, that's a large name in there. That's done a bit of a slippy slide. And you have Sun Pharma as well that's suddenly taken a bit of a knockout there. So a good resilient performance, one will have to say. But towards the end, the last 20-25 minutes odd, the bears have come back in style, it seems. They're not letting the bulls get away. 18,100, they want to defend that. Mitesh, what are you making of, this final 30 minutes or so where the bears have fought back? Levels you're looking at on the Nifty and your trading picks as well.
So, Nigel, actually, my understanding was that 18,050 may not be crossed on the upside. We did venture beyond that, the high being 18,071. But I think this is still a market, which with the gap breakdown should go into some kind of consolidation rather than, immediately restarting an uptrend. So I think that might still play out. We might have got a pivot at 18,071 now. And on the downside, 7850 remains the first area to watch it. I think it will be a market which will consolidate for next 2-3 sessions at least. On the stock side, Crompton is an STVT with a stop at about 408 and a target of around 397. And L&T Finance is something which I think can be taken on the long side, or BTST kind of a trade can be taken here. Keep a stop just below levels of around 83.5 and a target of around 86.5 can be taken.
Okay, all right. Thanks for that, Mitesh. Well, let's focus on the cement names. Ambuja Cement's higher in trade on the back of news flow of fundraising. Now, remember, they're going to be meeting on September 16th. No more details with regard to the quantum, to who the fundraise is going to be done, or the instrument as well. They're going to use equities, convertible equity. You're not really clear on that. Remember, in the recently concluded open offer, there wasn't any big success, and that's obvious because the share price was higher than the open offer price also. keep in mind that Ambuja Cements, well, they already have a good amount of cash. On a standalone entity, they have close on 4,000 crores. The consolidated entity, more than $1 billion odd. So now they'll be flush with cash. Why does the street like both these two stocks? That's ACICI as well as Ambuja Cements. They believe there's a new promoter. The Adani Group will be far more aggressive. And that's what could help them in terms of market share. Remember, the erstwhile promoter was, far below par, actually. And we didn't see any big capacity growth, didn't see any big aggression out there. The other factors on a cost basis, on a cost per ton, ACC and Ambuja, well, their cost is close to 200 rupees more than, say, an Ultratech or a Shree Cement. So the hope is that that'll get bridged, and maybe at some point of time there'll be a merger as well, which will bring in further synergy benefits. Why is the rest of the street buzzing? Well, because there is hope of consolidation. You have a new promoter coming in there, that's the Adani Group, with the big watchers. Are they going to be buying a few assets out? If that's the case, there'll be some consolidation. Consolidation leads to better pricing, and better pricing leads to better profitability. So those are the hope trades that are playing out there. That's the reason Ambuja is flying away, and the rest of the cement industry as well doing pretty well. Anand Tandem joins us. Anand, every fortnightly when we chat, we ask you what's your take on the cement stocks. I think now there's a bit of a risk, because even if there is consolidation, some of these names are going to get left out, which are trading above what they've traded in the past, particularly from the broader markets. Your take, stick to the large names if there is or there isn't consolidation, or do you believe some of these smaller mid-cap companies, they still have value out there?
Well, if you take value in the traditional sense of companies which are likely to be taken over, and where there is perhaps some kind of upside that may happen because of strategic moves, then the smaller ones are the obvious ones. Obviously, nobody's going to be buying the larger companies. But from a point of view of a business as usual, if you're looking for investing in companies, then the larger companies are expensive and the smaller companies will remain cheap. So I don't see significant upside from here for the sector as a whole, or for the market as a whole as it is. Because from here onwards, the risk to earnings is fairly high. They've taken a price hike. That price hike typically has not sustained in the third quarter. We are going to be, which is what we are going to be entering soon. The volumes have been somewhat suspect. So overall, I don't see that the scenario is such that you're going to have a runaway boom in terms of where the valuations already are reached.
Anand, we've tracked markets. And talked about markets with each other for a long time. Have you seen a day like today? We're down a little bit now, 0.5% or so. The US is down 5%. And the market actually was still 15 minutes back in the green.
Well, that's true. India has been amazingly resilient. And, there has been talk now of the fact that we've kind of not only decoupled from emerging markets, but also perhaps from the fact that we were earlier taking cue from what the developed markets are doing and don't seem to be doing that anymore. But if you look at where we are headed, I don't see much reason for the decoupling to happen. It is not as if we are on a different planet, not yet anyway. So if you are even, for example, we are talking about domestic capex as the big trigger for the market now, and if you see that's where much of the incremental flows are moving into. But the domestic capex is largely happening in those sectors which are meant to be PLI. So you are looking at those which are going to be looking for exports. So if the export markets are not going to do well, I don't know how the investments that you are making in capex at a time where your capacity utilization is still not very high is going to play out. Similarly, if you look at where the auto ancillaries are moving, which is again the next sector, which is besides banking, which is catching a lot of attraction. Yes, to some extent, India will obviously gain more traction. We are a very small part of the global market in terms of supplies, and therefore we will continue to increase. But again, if you have a slowdown in Europe, and you have the order book's not great in America, then I don't know where you're going to be selling these things to. So I think there is reason to be cautious, especially at these levels, for even those sectors where the analysts are the most bullish in terms of earnings growth.
Okay, all right, Anand, the valid view there, some bit of caution as well being put on the table. But stay with us, Anand. For the time being, we'll slip into a short break. Come back. We'll get Anand's view on a few more stocks and we'll wind down the market action for the day. Welcome back. Before we wind down on markets, we'll get a final take from Anand Tandem. Anand, the banks are doing very, very well. Now the street is getting a little bit adventurous. They're looking at some tier 2 banks, some NBFCs as well. Would you flirt with them, or do you believe stick to the large cap banks?
Tactically, I think we discussed this last time as well. The smaller banks may probably give you more upside, especially the public sector banks, largely because they're trading below book. Book has been relatively cleaned up. Credit growth is now happening, so they will also pick up some of the credit, and margins will therefore expand. So for the next 1 or 2 years, till the credit that they have expended moves into NPAs, you are going to see fairly good growth. The problem is that many of them do not have great credit analysis methodologies, and they will lend to companies that will have trouble if the cycle were to turn. So therefore, you are then looking back at those companies which are going to do it in a sustainable manner, and which is why you keep coming back to the larger banks. So long story short, corporate-facing banks, yes. For now, for the next year and a half, almost all public sector banks should do reasonably
well. Anand, anything, broadly, your view is that reason to be more kind of careful rather than go wildly bullish from these levels. But any other areas you like in particular? Anything you see a little mispricing somewhere, or you think it's kind of hard to do that now?
Well, even the smaller companies are fairly expensive. So actually, you are better off in the larger companies, because for a change, the small cap index is not trading at a discount to the large cap. So at least if you were to look at the top 200 or 300 companies, and you can always find some companies outside that. But if you restrict yourself to the top 200 to 300 companies, then you have to look for places where where perhaps the larger companies are not properly priced. One of those sectors, for example, to my mind, is power. There is a lot happening in terms of new orders coming in, even for thermal power plants, for NTPC, for NHPC. Of course, NHPC is not thermal, but I'm saying that even in renewables, there's a lot of activity that has begun to pick up on NHPC as well. So some of those which are still trading relatively cheap, which are almost dividend plays, are sectors which are, to my mind, still underpriced. Any sector which is very popular right now is not going to provide you value at least.
Okay, all right, Anand. Thanks so much for stopping by and giving us your view on a whole host of sectors. Wishing you a good evening ahead. Well, time to wind down then. The Nifty ended with a cut of close around 80 points odd, but it was a solid fight from the low point of the day. More than a 200-point recovery is what we saw at one point of time. The Nifty moved into the green. Unfortunately, towards the end, we did see some selling as well, but a closer to around that 18,000 odd mark. The bulls, they'll take it with both hands after what we were staring at earlier today. What didn't do too well? The tech stocks, Infosys, TCS, Tech Mahindra, HCL Tech, the top losers on the Nifty itself, down between 2.5% to around 5%. What did well? The banking names, they came back in style. IndusInd Bank, Kotak Mahindra Bank, both of them were up and about in today's trading session. You had select metal names as well that did bounce back. Tata Steel was up, Hindalco as well was up more than 1% odd, and NTPC as well did pretty well. From the broader market, cement was a theme that did play out. Ambuja Cement is going to be raising some capital. The street believes that there is going to be some consolidation that will take place. You had India Cements that was up and about. You had Dalmia Bharat as well that was flying away. ACC and Ambuja, obviously both of them as well were participating, and Sanghi Industries as well did do pretty well. The mid-cap index, well, the breadth of the market was still in favor of the number of stocks that were declining, so that narrowed considerably from the start of trade. What didn't do well? Well, the L&T twins in terms of the tech space from the broader markets, that's L&T Infotech and L&T Tech Services. Both of them were down 3 to around 4%. Coforge as well got hit. You had Birlasoft as well, that was down. Pyramid Enterprises, remember, some part of the street wanted only the pharma business. Now that they will be getting in the next couple of months or so. So there appears there is some persistent selling that we're seeing on Pyramid Enterprises. The stock is down close to around 2%, now below that 1,000 rupee mark or so. Bata as well was down close to around 2% or thereabouts. So really mixed action is what we got from the broader markets. But to wind things down then, well, the Nifty ended with a cut of close to around 70 points, ended closer to around that 18,000 odd mark. The Nifty Bank played an absolutely splendid knock today on the day that you had very, very weak global cues, and the index ended up with a gain of close to around 500 points, while the mid-cap index was mildly in the red. Well, curtains down on this edition of Closing Bell, but you don't go anywhere. Lots lined up on our special offering, Mad About Markets, coming up on the other side.